Ever find yourself wondering what's actually deductible when, your office is also your living room or maybe your kitchen table? That line between personal expenses and business expenses, especially for taxes, it can get really blurry, right?
Yeah.
Today we're going to do a deep dive into the fascinating and frankly pretty strict world of home office expense deductions. But before we dive deeper, just a quick reminder that this podcast is based on material from Farhat lectures. All the content, examples, and the explanations we're discussing today are derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student, maybe a CPA candidate, or already a professional, definitely visit the website. You'll find additional practice questions, video lectures, and detailed support to really reinforce today's topic. A special thanks to Professor Farhat for providing all this valuable material.
Absolutely. And it's true. The IRS is uh, incredibly strict on this topic. A lot of that comes down to the potential for abuse, you know, when personal life and business kind of blend together under one roof. So understanding these details, these nuances, it isn't just helpful. It's really critical if you want to stay compliant and, get the best tax outcome possible.
Okay, let's unpack this then, right from the start. A lot of people probably assume, hey, I work from home, I get a deduction. Simple as that. But my understanding is your employment status, whether you're self-employed or an employee, that creates a huge difference right away, doesn't it?
Oh, absolutely. That's the fundamental distinction, and it really impacts your taxes significantly. So if you're self-employed, your home office expenses, they go on Schedule C. That's where you report your business profit or loss. And these deductions, they're taken for adjusted gross income, or AGI.
Okay, for AGI, what does that really mean in practice?
Well, think of it like this. For AGI deductions, directly lower that income number before you get to other important calculations. It can affect things like your eligibility for certain tax credits, maybe even phase-outs. It's generally a more direct and often more powerful tax benefit.
Got it. More direct impact. So what about employees then?
Right. Now, if you're an employee and theoretically you qualified for these deductions, which honestly is a big if for most people right now, those expenses would usually be itemized deductions on Schedule A. That means they're deducted from AGI.
Ah, so after the AGI calculation, and only if you item it right.
Exactly. It only helps if your total itemized deductions exceed the standard deduction.
Yeah.
And even then, the impact might not be as broad. But here's the really crucial part for employees right now. Congress actually suspended those specific home office deductions for employees. That suspension runs from 2018 all the way through 2025.
Wow. Okay, so bottom line for employees currently is basically no home office deduction.
Generally speaking, for federal taxes, yes. If you're a W-2 employee working from home, even if your employer requires it, you likely won't be taking this specific deduction until after 2025 unless the law changes. And that AGI distinction we talked about. It's really important because it affects how your overall tax liability shakes out, not just where you write the number down.
Okay, so employment status is huge. But even if you are self-employed or, hypothetically an employee in the future, it's not automatic. I've heard the IRS has some incredibly strict rules just to even qualify. What are those non-negotiables?
You're right, they set a very high bar. And these rules, they apply whether you're self-employed or an employee, whenever employee deductions are allowed. First, the big one, exclusive use. That space has to be used only for your business, period.
Only. So like no guest bed in the corner, no kids' toys tucked away.
Exactly. It can't double as a playroom or a guest room or even just a general family area. The IRS wants to see a space that's genuinely dedicated 100% to your trade or business. Even, minor personal use could technically disqualify it.
Okay, exclusive use. What else?
Second, regular use. It has to be used consistently for business, not just occasionally, like answering emails once a week from the dining table. It needs to be a regular part of your business operations.
Makes sense. Consistent effort.
Third, it generally needs to be your main place of business. Now, this can mean a couple of things. It could be where you primarily handle your administrative or management tasks, think of bookkeeping, scheduling, ordering supplies, or it could qualify if it's a place where you regularly meet with clients, patients, or customers in the normal course of your business.
So either admin central or where you actually meet people.
Correct. And then for employees specifically, there's one more hurdle. It's a big one. The home office use must be for the convenience of the employer.
Convenience of the employer, not just easier for me.
Precisely. It means your employer requires you to work from home. It's not just an option they offer, or something you choose because you prefer it or, say, dislike the commute. If you could work at the employer's office but choose not to, that usually doesn't meet the test. The employer has to be the driving force behind you working from home. That's a point that trips up a lot of people.
Wow, okay. Exclusive use, regular use, main place of business, and for employees, convenience of the employer. That's quite a list.
It is. They really want to ensure it's a legitimate business necessity, not just deducting personal living costs.
All right, so let's say you actually jump through all those hoops, you meet the criteria. How do you calculate the deduction? Let's start with what's called the regular method, sometimes called the actual expense method.
Yes, the regular method involves tracking your actual expenses.
Yeah.
And you basically divide them into two buckets.
Direct and indirect.
Direct and indirect. Okay, what's the difference? Direct expenses are costs that apply only to your office space. So think about maybe painting just the office walls, or installing specific flooring only in that room, or maybe a repair that solely fixed something within that defined office area. Because these costs are 100% for the business space, you deduct them in full.
Simple enough. If it only touches the office, it's fully deductible.
Right. Then you have indirect expenses. These benefit your entire home, both the business part and the personal part. We're talking things like your mortgage interest, your property taxes, homeowner's insurance, utilities like electricity and heat, maybe general home repairs like fixing the roof.
Okay, so the stuff that keeps the whole house running, how do you handle those? You can't deduct the whole amount, obviously.
No, you have to allocate them. You need to figure out what percentage of the expense relates to the business use of your home. The most common way, and generally the IRS accepted way, is based on square footage. You figure out the square footage of your dedicated office space and divide by the total square footage of your home.
So if my office is, say, 100 square feet and my house is 1,000 square feet, that's 10%.
Exactly. You'd then generally be able to deduct 10% of those eligible indirect expenses, 10% of your utilities, 10% of your homeowner's insurance, and so on.
Okay, that makes sense. But I've heard there's a catch, especially for self-employed folks. Something about not being able to create a loss.
Ah, yes. That's a crucial limitation with the regular method for the self-employed. Your home office deduction cannot exceed the gross income from your business after you've already subtracted your other non-home office business expenses.
So you can't use the home office deduction itself to push your business into showing a net loss on paper.
Precisely. You can bring the net income down to zero, but not below zero using the home office expenses. It prevents using home costs to offset other income sources via an artificial business loss.
What happens if your calculated home office expenses are actually higher than that limit? Are those extra deductions just lost?
Not necessarily. Some parts might be usable elsewhere, and others can be carried forward. The business portion of your mortgage interest and real estate taxes, for example, those are usually deductible anyway as itemized deductions on Schedule A if you itemize. So even if limited on Schedule C, you might still get the deduction there.
Ah, okay. So they don't just vanish.
Right. And other expenses, especially depreciation, which can be a fairly large number sometimes, any amount you can't deduct in the current year due to the income limitation can be carried forward to future tax years. You can use that carryover amount to offset income from the same business in later years, assuming you have enough income then.
That's good to know. Is there an order you have to deduct things in?
Yes, there's a specific order. You first apply the expenses that would be deductible anyway. That's typically the allocable portion of mortgage interest and real estate taxes. Then you apply your other operating type expenses like insurance and utilities. And finally, you apply depreciation. This order matters because it maximizes the chance you can deduct the interest and taxes, either on Schedule C or potentially Schedule A.
Okay, this feels like a good time for an example to tie it all together. Let's use Adam. He's a CPA, but he also runs the side tutoring business from his home. He uses 2 basement rooms, let's say they total 200 square feet, exclusively for this tutoring. His whole house is 2,500 square feet, so that office space is 200 divided by 2,500 is 8%, not 10%. But the example calculation I have uses 10%. Let's stick with 10% for the calculation consistency. As per the source material example, maybe the rooms were slightly larger or the house smaller in that specific calculation. So 10% business use.
Okay, using 10% for allocation. Got it.
Right. His tutoring business brings in $6,000 in gross income. He also has $4,000 in other direct business expenses, maybe software, advertising, things like that. His total annual home expenses are $9,000 in mortgage interest, $5,000 in property taxes, $600 for homeowner's insurance, and he calculated $400 in depreciation allocable to the office space. How do we calculate his deduction using the regular method, keeping that income limit in mind?
Okay, let's walk through Adam's numbers step by step. First step, determine the income limit. Gross income from tutoring is $6,000. Subtract the other business expenses of $4,000. So $6,000 minus $4,000 leaves $2,000. That $2,000 is a maximum home office deduction Adam can take this year.
Okay, ceiling is $2,000. Now we apply the expenses in order.
Correct. First, the allocable mortgage interest and property taxes. His total interest and taxes are $9,000 plus $5,000 plus $14,000. We're using the 10% allocation factor. So 10% of $14,000 is $1,400. We deduct that $1,400 from the $2,000 limit. So $2,000 minus $1,400 leaves $600 remaining that can potentially be deducted.
All right, $600 left. Next up is insurance.
Yes, the example states his allocable homeowner's insurance is $250. Since $250 is less than the remaining $600 limit, he can deduct the full $250. So we subtract that. $600 minus $250 leaves $350.
Okay, down to $350. And the last piece was depreciation, which was $400.
Right, he calculated $400 in allocable depreciation. But he only has $350 of income limit remaining. Because the deduction can't create a loss, he can only deduct $350 of that depreciation this year.
And the leftover $50.
That remaining $50 of depreciation, $400 calculated minus $350 deducted, gets carried forward. He could potentially use it next year against tutoring income, assuming he has enough.
So his total home office deduction this year is the $1,400 interest taxes plus $250 insurance plus $350 depreciation equals $2,000. It maxed out his limit.
Exactly. The calculation followed the order and respected the income limitation perfectly.
That was a lot of steps. Meticulous record keeping, allocation percentages, deduction order, income limits, carry forwards. I can see why people might look for something easier.
Well, definitely. It requires careful tracking throughout the year, which is why the IRS introduced the simplified method.
The simplified method. Okay, tell me this is actually simple.
It really is, comparatively. It's also called the safe harbor method. Instead of tracking actual expenses, you use a prescribed rate. The rate is $5 per square foot of your qualified home office space.
Just $5 per square foot. That's it.
That's the core of it. There is a cap, though. The maximum square footage you can use for this method is 300 square feet. So the absolute maximum deduction you can get under the simplified method is $1,500 per year. That's $5 times 300 square feet.
Okay, $5 per square foot, max 300 square feet, max $1,500 deduction. What's the catch? What don't you get?
The main thing is you cannot deduct depreciation for your home office if you use this method. You also don't deduct any actual expenses like utilities or insurance for the office space itself. It's just the flat rate.
No depreciation. That sounds like a downside, maybe.
It can be if your actual expenses and depreciation would have given you a bigger deduction. But there are significant upsides, too. First, simplicity. Obviously, less record keeping. You just need to know the square footage. Second, remember how, under the regular method, part of your mortgage interest and property taxes got allocated to the business.
Yeah, reducing what you could potentially deduct on Schedule A.
Exactly. With the simplified method, none of your mortgage interest or property taxes are allocated to the home office deduction. So you get to deduct the full amount of your qualified home mortgage interest and property taxes on Schedule A if you itemize. That can be a big benefit.
Oh, interesting. So it frees those up completely.
Yes. And third, because you're not taking any depreciation deduction, there's no depreciation recapture tax when you eventually sell your home.
Depreciation remind me what that is again.
When you sell your home after claiming depreciation on it, like with the regular method, the IRS basically wants to tax back some of that benefit. A portion of your gain equal to the depreciation you claimed is typically taxed at a higher rate, up to 25%, instead of the lower capital gains rates.
Ouch. So simplified method avoids that completely.
Correct. No depreciation taken, no recapture later. That could be a really significant saving down the line, depending on how much depreciation you might have otherwise claimed in your home's appreciation.
Okay, let's quickly run Adam's numbers again, but using the simplified method. How does it look? Now, the outlines simplified calculation example uses 250 sesquerete for Adam. Let's use that number here.
All right, simplified method for Adam using 250 SQA. Same starting point. $6,000 gross income minus $4,000 other business expenses leaves $2,000 of income available for the deduction. His office space for this calculation is 250 square feet. The rate is $5 per square foot. So 250 square feet times $5 equals $1,250.
$12,250, and that's less than his $2,000 income limit.
Correct. So he can deduct the full $1,250 as his home office expense. His remaining net income for the business is $2,000 minus $1,250, which equals $750.
So under simplified, he gets a $1,250 deduction straight off his business income.
Yes. And remember, his full $9,000 mortgage interest and $5,000 property taxes are now potentially available to be deducted on Schedule A if he itemizes.
Let's compare quickly. Regular method resulted in deductions totaling $2,000. $1,400 interest taxes, plus $250 insurance, plus $350 depreciation, effectively reducing his business income to zero, but using up part of his interest taxes. Simplified method gives a $1,250 direct business deduction, leaving $750 business income, but frees up all his interest taxes for Schedule A.
Exactly. In his case, the simplified method gave a smaller direct deduction against business income, $1,250 versus $2,000 total using regular method components, but potentially offers a better overall tax picture by allowing full itemization of interest and taxes, plus avoiding depreciation recapture. It really depends on the taxpayer's whole situation.
So, if you qualify for both methods, which you have to reevaluate each year, it seems like a pretty strategic choice. How do you decide?
It is definitely a strategic annual decision, and you really need to weigh the pros and cons for your specific situation each year. First off, remember, the core eligibility rules, exclusive and regular use, apply to both methods. You have to meet those regardless.
Right, the entry requirements don't change.
Okay, so comparing them. Simplified is obviously much easier. Less math, less paperwork. You just need that square footage number. Plus, no depreciation recapture down the road, and it frees up interest and taxes for Schedule A. That's very appealing for simplicity and potentially for the sale of your home later.
And the regular method.
The regular method might give you a larger deduction in a given year, especially if your actual allocable expenses, particularly depreciation on a valuable home or high utilities or significant direct expenses like repairs, add up to more than the $1,500 simplified cap. But it comes with that heavy record-keeping burden. You need receipts, calculations, the whole 9 yards, and you have to deal with potential depreciation recapture when you sell.
And you make this choice every year.
Yes, it's an annual election. You can use the regular method one year and the simplified method the next, or vice versa, depending on what makes sense for that specific year's numbers. But here's a really critical point. Once you file your tax return for the year using one method, you generally cannot go back and amend it later just to switch to the other method for that same year.
So choose wisely for the year you're filing.
Choose wisely. The decision for that year is binding once filed.
Okay, this has been incredibly insightful. As we wrap up, thinking about people navigating this, especially with remote work being so common now, what's the single biggest takeaway or piece of advice?
I think the biggest takeaway is this. While the rules can feel really specific, maybe even arbitrary sometimes, understanding the reasoning behind them helps a lot. The IRS is trying to draw a clear line between personal and business life, prevent abuse, and ensure deductions are allocated properly, knowing that why can make the what's and how a bit easier to grasp. And, practically speaking, records, records, records. Keep meticulous, organized records of your expenses and your office usage. Whether you use the regular method or just want to properly calculate the square footage for the simplified method, good records are absolutely essential. They are your best friend if you ever need to justify your deduction.
Makes perfect sense. So, whether you're self-employed, carving out a workspace, or just trying to understand the landscape, knowing these rules is vital. We've covered the big split between employee and self-employed rules, the strict qualifications, and that annual choice between the detailed regular method and the, well, simpler, simplified method.
You know, it really does raise an interesting question looking forward, doesn't it? As remote work keeps evolving, maybe becoming even more standard. How might these tax rules, which feel pretty rigid right now, need to adapt? Or maybe how will taxpayers continue to creatively and legally navigate them? It's a dynamic space.
That's a great point. Will the rules catch up to the reality of modern work? A question for the future, perhaps. It definitely leaves you thinking about whether the current system truly reflects how business gets done today. If you're looking to dive even deeper into this, remember today's discussion draws from materials at Farhat Lectures. You can find more practice, video lectures, and tons of support on topics just like this and many others over at farhatlectures.com. Thanks so much for joining us for this deep dive. We hope it shed some light on a complex topic, and we'll see you next time.